All right, let's just get straight to it. Welcome to The Explainer. Most of us probably just think of a loan as borrowed cash, right? It's that necessary stepping stone to buy a house, grab a new car, or finally launch that business. But today, we're going to completely flip that perspective. We're looking at the actual anatomy of a loan, not just as a pile of money changing hands, but as a strict, highly structured legal contract. One that's packed with some pretty fascinating mechanics and, believe it or not, some absolutely wild tax implications. So here's a question for you. What is the true cost of renting money? Because fundamentally, that is exactly what debt is. You aren't buying capital. You're renting it from a financial institution for a very specific window of time. And the rent you pay for that leverage, well, that's your interest. At its core, a loan is simply the tender of money by one party to another, backed up by a rock-solid agreement to pay it back. It's really just a temporary reallocation of an asset between the lender and the borrower. Now, to make this whole thing official, it gets documented by a promissory note. This note sets the rules of the game, the principal amount you borrowed, the exact date of repayment, and, of course, the interest rate. And here's the crucial part. That interest is the ultimate incentive. It is literally the only reason the lender agrees to hand over their capital in the first place, enforcing all these obligations through a legally binding contract. Now, this core agreement generally plays out in two major ways: secured versus unsecured loans. On the secured side, loans require you, the borrower, to actually pledge a physical asset, like real estate or corporate equipment, as collateral. The lender gets what's called a security interest. Think of it like a lien on your property's title. If things go south and you default, they have the full legal right to repossess that house or car and sell it to get their money back. And because the risk is managed so well, your interest rate is usually a whole lot lower. But then, on the unsecured side, these loans are totally unbacked by your assets. The lender is basically operating on trust and the legal contract itself, which, as you can imagine, radically shifts the whole risk dynamic. What's really fascinating here is just how incredibly common unsecured loans are in our day-to-day lives. We're talking about your credit cards, personal loans, standard bank overdrafts, lines of credit, corporate bonds, and even peer-to-peer lending. But here is the major catch. Because there is absolutely zero collateral pledged, if you happen to default on an unsecured loan, the lender's options are pretty heavily restricted. I mean, their only real recourse is to drag you to court, sue you for breach of contract, get a money judgment, and then try to go after your unencumbered assets, basically the stuff you haven't already promised to someone else. In a bankruptcy or insolvency situation, they are literally at the back of the line. So how do lenders make up for taking on all that extra risk? Yep, they charge you significantly higher interest rates. So who's actually taking out all these loans? Well, the target market pretty much splits into two main demographics. On the personal side, you've got everyday consumers applying for things like mortgages, home equity lines, installment loans, or even payday loans. In this arena, your financial reliability is judged primarily by your personal credit score. That three-digit number heavily dictates the underwriting in your APR. But if we flip over to the commercial side, loans made to actual businesses, they aren't looking at personal credit scores. Instead, the underwriting is driven by broader corporate credit ratings to issue things like commercial mortgages, corporate bonds, and government-guaranteed loans. But honestly, regardless of the market you're in, the underwriter is just constantly crunching the numbers to calculate your specific risk profile. And that specific risk profile, that's what dictates how you pay the money back, which is most often through a fully amortizing payment schedule. This is where borrowers constantly get caught up in a harsh mathematical reality, known as the amortization impact. See, when a loan is fully amortized, each monthly payment is the exact same fixed value over time, blending together the principal and the interest. Now, if you want a lower, more manageable monthly payment, it's simple, right? You just stretch out the term of the loan. It feels fantastic for your monthly budget, but the trade-off is absolutely massive. By stretching out that timeline, the total amount of interest you pay over the life of the loan just skyrockets. All right, let's step away from the standard mortgages and credit cards for a second, because the lending world is actually highly versatile. It's incredibly customized. For instance, we have demand loans. These carry a floating interest rate, and the lending institution can literally call them in for full repayment at any given time. Imagine just waking up to a notice that your entire balance is due today. Then there are subsidized loans, like a lot of U.S. college loans, where the interest is reduced or sometimes paused entirely by a subsidy while you're taking classes. Concessional or soft loans offer incredibly generous below-market terms. These are often given by foreign governments to developing nations, or even handed out as a special perk to employees. And finally, bridge loans. These require heavy collateral and usually carry steeper interest rates, but they offer fast cash flow to literally bridge a gap, like when you need to buy a new piece of commercial real estate before your old property actually sells. But wherever there is a transfer of money, there's always the potential for exploitation. We have to look at the dark side of lending because the system is definitely not always fair. We see predatory lending, where loans are intentionally granted just to put the borrower in a vulnerable position so the lender gains an advantage. Think about those unregulated, unauthorized loan sharks hanging around the payday lending space. Then you've got usury, which is this distinct form of abuse where lenders charge just completely excessive interest. Actually, consumer organizations are frequently accusing credit card companies of usurious rates that they hide in frivolous extra charges. And it's important to note this goes both ways. Abuses absolutely happen from the borrower's side too, like taking out funds with zero intention of ever repaying them, which is just straight up defrauding the lender. Okay, now we're entering the incredibly precise and honestly fascinating world of the U.S. tax code, guided by rules from Congress and the Treasury Department. How exactly does the IRS view this rented money? Well, if you receive a principal transfer, let's say you borrow 100 grand, it is actually not considered gross income. Why? Because you have a strict legal obligation to pay it back. There is no true accession to wealth here. You didn't get richer, you just got leverage. And for the lender, handing you that cash isn't deductible from their income because they just converted one asset, cash, into a different asset, a promise of repayment. The real magic happens with the interest. Paying interest might be deductible for you if it's for a business or a home mortgage, but for the lender, that interest they receive is undeniably gross income. That is their compensation, their taxable profit for letting you use their property. Which brings us to a scenario that probably sounds like an absolute dream for any borrower. What happens if your debt is simply erased? Let's say the lender just tears up the contract. You don't have to pay a dime back. Sounds amazing, right? A total burden lifted. Well, hold on, because the Internal Revenue Code has a very specific and highly consequential answer to this exact situation. Let's walk through a $50,000 example. Under Section 108 of the Tax Code, which specifically deals with cancellation of debt income, if you owe a lender 50 grand and they officially discharge that indebtedness, you no longer owe it. But remember just a minute ago when we established that a loan isn't initially income because you have the obligation to pay it back? Well, now that obligation is entirely gone. So in the strict unblinking eyes of the IRS, your personal wealth just magically increased. They calculate your income exactly as if that lender had just walked right up to you and handed you $50,000 in cold, hard, taxable cash. The financial ledger is totally inescapable. Erased debt just magically transforms into taxable income. The system always demands that it balances out. You either pay the lender the principal and the interest you originally promised, or if you're lucky enough to have that debt forgiven, you are very likely going to end up paying a hefty chunk of that value directly to the taxman. It really makes you rethink what it actually means to sign a promissory note, doesn't it? The true cost of renting money goes way, way beyond just that monthly payment. So I'll leave you with this. The next time you sign a contract to rent someone else's money, are you truly prepared for every hidden rule attached to that cash? Really think about it. Thanks for joining me on this explainer, and I'll catch you next time.